government policy significantly influences the value of the Kenyan shilling. However, money demand and supply remains the core principle that determines the value of the Kenyan shilling. Interest rates equally play a crucial role in the determination of the value of the Kenyan shilling. Hello, I'm Danga Shadrach, and a very warm welcome. Ideally, money demand and supply ought to be equal in the economy in a state of equilibrium. Whenever money supply in the economy is more than the money demanded, the value deteriorates and the interest rate increases. On the contrary, whenever money demand is more than the money supply, the interest rate decreases and inflation is controlled and the shilling strengthens. Therefore, by the government influencing money demand and supply and the interest rates, the government influences the value of the Kenyan shilling. The Kenyan government policy manifests itself distinctly in the form of 1. Monetary policy and 2. Fiscal policy. Monetary policy is primarily due to the institution of the Central Bank of Kenya. The Central Bank of Kenya can influence money supply and the interest rates, thereby influencing the value of the Kenyan shilling. The Central Bank of Kenya uses an array of tools to influence money supply and the interest rates in the economy. 3 major tools used by the CBK include open market operations, which basically means the CBK sells and buys government securities. When the CBK buys government securities, money supply is increased in the economy. This may cause inflation, thereby lowering the value of the Kenyan shilling. When the CBK sells government securities, money supply is reduced in the economy. This puts inflation in check, ultimately strengthening the Kenyan shilling. Secondly, the CBK discount rate. This is the interest rate at which commercial banks borrow from the central bank. When the CBK charges high discount rates, commercial banks also charge high interest rates. This discourages borrowers, thereby reducing lending and reducing the money supply in the economy. This ultimately strengthens the Kenyan shilling. When the CBK charges low discount rates, commercial banks also charge low interest rates. This encourages more Kenyans to borrow, thereby increasing the money supply in the economy, which may fuel inflation that weakens the value of the Kenyan shilling. Additionally, every commercial bank in Kenya is mandated by the Central Bank of Kenya to reserve a proportion of their money as reserves. The central banks determine the proportion to which they reserve. For instance, a commercial bank had 1,000 shillings and the fractional reserve requirement is 10% of their total money assets. The commercial bank will have to set aside 100 shillings as reserve, hence they will remain with 900 shillings to avail for borrowers. When the fractional reserve is high, commercial banks have less money to avail for lenders. Whereas, when the fractional reserves are low, commercial banks have more money to avail for lenders. Increased borrowing increases the money supply in the economy, whereas reduced borrowing decreases the money supply in the economy, ultimately affecting the interest rates and the inflation of the country that influences the value of the Kenyan shilling. It will be worth noting, on the other hand of fiscal policy, the key player is the executive in the annual budget making process and the finance bill. Key tools used here include taxation and government spending. Here, the government still influences money demand and supply in the economy and the interest rates. However, the key objective is economic prosperity in the country by increasing or decreasing economic activity in the country. When the government increases taxation, it lowers people's disposable income, thereby curbing spending and investment, lowering inflation and strengthening the shilling. Whereas, when the government lowers taxation, it leaves more money in people's pockets that encourages spending and investments and boosts economic activity in the country, which may result in inflation that lowers the value of the Kenyan shilling. Additionally, when the government increases spending on infrastructure, social programs and public services, it injects money into the economy, which encourages spending and investments, boosting economic activity in the country that may cause inflation that weakens the Kenyan shilling. On the contrary, lowering government spending may put inflation in check and strengthen the Kenyan shilling. It is imperative to note that investor confidence in the Kenyan shilling equally plays a crucial role in the determination of the value of the Kenyan shilling. When investors have high confidence in the value of the Kenyan shilling, there is a spike in demand for the Kenyan shilling. This leads to appreciation and strengthening of the Kenyan shilling.